Hi, Assalamualaikum and hello everyone. My name is Aina Syamimi binti Muhammad with student ID 6221322080 and my group mates are Nik Anis Ilyana binti Nik Baharudin with student ID 622131202323 and Nur Fatin Madieha binti Ahmad Almi with student ID 6221312082. And we will explain and presenting about assertion completeness. So, what we need to know about audit assertion? Audit assertion can be defined as the implicit or explicit claims and representations made by the management that have responsibilities in preparing the financial statements regarding the appropriateness of the various elements of financial statement and disclosures. During the preparation of financial statements, the management is making implicit or explicit claims, as known as assertions, regarding the recognition, measurement and presentation of assets, liabilities, equities, income, expenses and disclosures in accordance with the applicable financial reporting framework, example, IFRS and ISA. So the example for audit assertion is if a balance sheet of company shows the building with carrying amount of 25 million ringgit, the auditor must have assumptions that the management has claimed that the buildings are valued accurately in accordance with the measurement basis, the company is the owner or controller to those buildings, the buildings are recognized in the balance sheet and existed on the date of period ended, or all buildings that owned and controlled by the company are included within the carrying amount of 25 million ringgit. There are several types of assertions, but in audit assertion have three types of audit assertion, which is transaction level assertions, account balance assertions, represent and disclosure assertions. In transaction level assertion have completeness, accuracy, classification, occurrence, and cut-off. While in account balance assertions, it have rights and obligations, existence, completeness, and valuations. While in represent and disclosure assertion, it have accuracy, occurrence, completeness, understandability, rights, and obligation. Next is there is a short video that explains more about the types of assertion in auditing. So after watch this video, we will recognize that every types of audit assertion need the completeness assertion.
If these assertions are correct, then financial statements will automatically be reliable. It recognizes three different categories which are classified as follows. Firstly, assertions about classes of transactions and events. This typically impacts your statement of comprehensive income or income statement. First assertion, occurrence, meaning transactions and events so recorded in the financial statements actually occurred and relates to the same period. Completeness, all such transactions and events that require recording have been recorded. Accuracy, transactions and ancillary information have been recorded with accurate amounts. Cut-off, only those transactions and events that have been recorded that pertain to the accounting period under consideration. Classification, transactions and events have been recorded in the related accounts properly. The next group of assertions all relate to assertions that impact account balances or the balance sheet or the statement of financial position at a period end. Existence, all the assets, liabilities and other interests that appear in the financial statements actually exists. Rights and obligations, the assets presented in the financial statements are actually assets for which the entity holds the ownership, right, or has all the necessary controls to the rights of use of the asset. Similarly, the liabilities recorded are actually the obligations of the entity. Completeness, all the assets, interest, and obligation of the entity that required recording have been recorded in the financial statements. Valuation and allocation, all the assets, obligations, and and equity interests have been valued appropriately, and if any allocation was needed, that it has been done already. The third group of assertions relate to presentation and disclosure. Firstly, occurrence and rights and obligations. Transactions, events, and the related or other matters disclosed in the financial statements actually occurred. Completeness. All the necessary disclosures that require have been recorded. Classification and understandability. Financial information in the financial statements has been presented appropriately with clear expression of disclosures to the extent possible to help users of the financial statements. And then lastly, accuracy and valuation. Financial or non-financial information is disclosed in the financial statements fairly. This explains the assertions and their applicability to the audit. Once we delve into specific sections, we will unpack this in more detail.
So, the selected audio assertion types that we have choose is completeness. So in the completeness, we will reveal or explain more about the completeness in audit.
What is completeness? It can be defined as all transactions and events should have been recorded and all related disclosures have not been omitted from financial statements. It exists in all types of assertions. The first assertion is assertion relating to classes of transactions. Completeness means all transactions that were supposed to be recorded and recognized in the financial statements. For example, salaries and wages costs. Salaries and wages costs in respect of all personnel have been fully accounted for. Second assertion is assertion relating to account balance. Completeness means the all asset, liabilities and equity interests that should have been recorded and all related disclosures should have been included in the financial statements. For example, inventory balance. All inventory units that have been recorded need to be recognized in financial statements. Any inventory that held by a third party on behalf of the audit company has been included in inventory balance. Based on the example, the auditor with completeness assertion may concern that some purchases were made at the end of the year were not recorded. This would cause the documents not be completed. This concern is understatement of purchases and related to account payable. Last but not least, assertion relating to presentation and disclosures. Completeness means all transactions, balance, events, and other matters must have been disclosed in financial statements. For example, related party disclosures. The things that the entity must be disclosed in the notes of financial statements are A. Any additional information, changes in policy, changes in depreciation methods or measurements. B. All related parties transaction and balance.
Do you guys know what will happen if the auditor does not using completeness assertion during their time auditing the financial statement of the company? First, the company's financial statement become less relevant. Second, the management of the company will make a decision only based on the partial view of the information and become less reliability on its financial statement. This is the real-life example based on WorldCom accounting scandal. In this Fox News article that published on 2002, its main topic was the WorldCom discloses $3.8 billion accounting scandal. Global markets real. The explanation for the example: WorldCom is one of the world's largest telecommunication firms and a core dividend-paying stock in many retirees' portfolios. However, in 2001, the management of this company make an assertion or claims that it have earned profit earning amounted to $3.8 billion on its profit and loss statement, which in fact it does not exist. The documents that had been manipulated and affected were its income statement, balance sheets, Form 10K filing, and annual reports. Unfortunately, the accounting irregularities were discovered during an internal corporate audit, which revealed that the company's profits had been inflated over the previous 5 quarters. The outcomes then appears to be the one of the biggest accounting frauds in U.S. history, and several former executives involved in the fraud were held responsible for their involvement. In 2002, WorldCom went bankrupt following its massive accounting fraud and became one of the largest bankruptcies. That's all from us. Thanks for watching.